Hi, this is Jyoti Prakash from PRP Edge. Now, around the 1st and 2nd of October, there was a lot of chatter around Credit Suisse defaulting. But over the next couple of days, that is 3rd and 4th of October, the markets rallied by 5.7%. And why did this happen when many investors assumed that this was a new Lehman crisis kind of moment, which had brought the markets to its knees in 2009? Anyone who mattered had something to say on Twitter on this subject. Even the famous Wall Street Journal came up with an article where it outlined both sides of the balance sheet of Credit Suisse and saying how it was in big trouble. The market anyway was jittery, and on 30th September, the market had tested a new 52-week low. So the market participants were nervous in any case. The equity market setup was also quite bad because there were geopolitical tensions with Russia deciding to announcing to annex parts of Ukraine. Russia was prevailing upon the OPEC countries to reduce the output of crude oil, and there was talk about Russia having sabotaged the gas supplies onshore. Meanwhile, the Bank of England had decided to take a U-turn from quantitative tightening to some kind of quantitative easing. So there are a lot of things which are happening, which was anyways creating uncertainty in equities, and we couldn't afford to have one more uncertainty like the default by Credit Suisse, and that crippling the banking system. As on 30th September, the investors in US equities and bonds were staring at losses of $58 trillion, which is such a huge sum of money. Investors had sold into equities, and the markets, in terms of the percentage of stocks below 50 days, was at record high. We are talking about 50 days moving average. Investors wary of further, depletion of their wealth were buying puts, and the ratio of put to call was at 8, which was at historic highest levels. There is this survey which is carried out of American investors, and that pointed to a situation where investors were bearish, the third highest level in the history of this survey. So a majority of the investors were bearish about the equity outlook. If you looked at the technology stocks, and these are better valued in terms of price to sales, and there also we were seeing that they were trading at 4.5 times, which was significantly below the recent peak of 8.5 times. So what were investors doing? They were piling into money market instruments, and there was about $5 trillion invested in money market instruments, which is 100% more than what is normal. But lo and behold, what happened on 3rd and 4th of October? The markets went up by 5.7%, and this has been the highest two-day rally since 2009. So contrary to the majority of investors expecting the markets to decline, the markets went up. Of course, there are other positive news, is that the Chancellor in UK reversed the decision to cut tax rates. Bank of Australia hiked interest rates by 25 basis points and not by 50 because of kind of housing crisis which is there. The US jobs data showed that the ratio of job openings to unemployed fell from 2 to 1.7. So these were other positive things which happened. But the moral of the story is, please be data driven. There is plenty of data that's there in the social media, which will help you to take decisions objectively. And the worst thing to do is to be selling stocks when markets have anyways corrected significantly. Thank you for watching. Wishing you all the best.